Guys, warm welcome to another week ahead video. This week's video will cover the trading week running from Monday the 6th to Friday the 10th of December 2021. Now, our main focus in this upcoming week will be overall risk sentiment. I mean, we've seen some pretty punchy moves in risk assets across the board, very bumpy ride to say the least over the past 2 weeks. Looking at things like the S&P futures were down almost 5% at some stage last week. Taking a look at NASDAQ futures, down almost 8% at some stage. WTI taking a massive 20% tumble. Implied volatility measures like the VIX closing above 30 on Friday. OVX, which of course is oil volatility, closing at 64. Again, very, very high numbers. Looking at those high beta versus safe haven currencies on the left-hand side of here, we've got the Aussie and the Kiwi currency indexes, both of them pushing to the downside sharply in the last 2 weeks. And of course, a very sharp push to the upside in the likes of the Japanese yen as well as the Swiss franc. On the left-hand side, at the bottom here, we've got US 10-year yields pushing to the downside, a 30 basis point move from the highs of 2 weeks ago to the lows this week. Very, very big move to the downside in 10 years. And we've also seen, further curve flattening taking place. We can see the 10s and 2s and 5s and 30s here in white and yellow, both of them continuing to flatten and pushing to the downside. Now, of course, the very first trigger that we had for this most recent route to the downside was, of course, the recent Omicron variant that came on the scene. That sent jitters through markets across the board last week and Friday, 2 weeks ago and Friday. But, this most recent Friday sell-off that we had was triggered not just by the Omicron variant, but more by further hawkish expectations for Fed policy going into next year. The most important chart for me from this past week is this one, which is just a very simple Eurodollar calendar spread between the December 2023 contract and December 2024 contract. And what this is showing us is that the market sees the last Fed hike taking place in 2023 and absolutely no hikes priced right now for 2024. And that implies that the current or most recent aggressive shift that we've seen from the Fed is largely being seen by the markets right now as a policy mistake. Now, for the past few weeks, we've been flagging possible downside risks for US 10-year yields, as well as a flatter curve, a flatter 10s and 2s, as both a patient or a more aggressive Fed should have meant downside risk for US 10-year yields either way. Now, obviously, we had the more aggressive tilt coming out from them, but with the Fed taking that more aggressive route, we've seen US 10-year yields obviously outperform the long as expected. But, it does seem, taking a look at the speed and the size of that downside move we've had in the 10s and 2s, it does seem that the growth and the inflation outlook seems to have meaningfully or materially deteriorated more than expected. So even though Omicron, shares the blame for some of the recent volatility we've seen and risk off tones we've had, the Fed's doubling down on a faster taper and obviously talking up the possibility of higher rates, the likes of daily this week. That isn't really going down well right now. A faster taper in itself isn't really the problem here. It's the fact that the Fed is getting overly hawkish at the worst possible time. Markets have been expecting both growth and inflation to decelerate going into 2022. That shouldn't have been a surprise. But the Fed tightening aggressively into that possible slowdown is bringing back a lot of 2018 memories for some participants. The fourth quarter of 2018 was just it was a bloodbath for risk assets. Across the board, we had yields tanking, we've got equities lower, we had commodities lower. High beta FX were all tumbling. The dollar was absolutely soaring across the board because the Fed was overly hawkish at that time, overly hawkish and planning to hike rates into a slowdown in both growth and inflation. Now, in December 2018, the markets, the Fed at least, was still expecting to hike around about 4 times in 2029. And then, of course, the markets had a huge, freak out and meltdown. It saw the S&P tumbling down almost 20% or more than 20% from the 2018 highs to the 2018 lows. And the problem, again, it wasn't a hawkish Fed. The Fed was hawkish for long before that eventual meltdown took place. But what really, shoved the markets over the edge was an overly hawkish Fed that was aggressively tightening policy with a looming rate of change slowdown in GDP as well as CPI. Now, it's important to acknowledge that, again, a slowdown in growth and inflation was always expected to occur next year. The reason why markets weren't too fazed by it is partly due to just the uncertainty right now surrounding things like supply chain disruptions and how that is affecting price pressures, and obviously also partly because we'll be slowing to levels which is still expected to be fairly high compared to the past couple of decades averages. So it wasn't a major concern for the markets until now. But in terms of cyclicality, apart from 2018, there's also far more similarities between the current price action we're seeing across major asset classes and the 2014 move we had, where we also saw similar things happening. Obviously, if we take a look at this chart, very similar to that time, we had the Fed expected to hike rates where we are right now. We saw twos pushing up like we see right now. We saw tens, yield curve pushing lower. We saw oil prices pushing lower. So lots of similarities to what we're seeing right now compared to 2014. The biggest difference, of course, being between 2018, what happened, and 2014 is that rates were stuck at the lower bound back in 2014, just like they are right now. Well, in 2018, rates were sitting at 2.4% in terms of Fed Fund future, Fed funds, the Fed funds rate when the markets had that meltdown. So what does all of this mean for us? It means that markets right now is at a little bit of a crossroads, because we're seeing similar price action taking place across major asset classes like we had back in 2014, but we're seeing that very similar hawkish Fed moving in, aggressive tightening expectations into a possible slowdown. So we have very similar price action between 2014, but a similar possible market reaction playing out compared to 2018. So again, that leaves markets at a little bit of a crossroads, because either the Fed needs to soften their language considerably, or we need really, really positive news about Omicron. If neither of those two things happen in the next couple of days, the current plan might just be, or the current pain rather might just be the start with the current levels of froth as well as leverage that we have in the markets right now. So what exactly is the trade then in the next week? Now, as you guys know, we still hold a favorable outlook for things like equities. We still hold a favorable outlook for things like WTI and currencies like the Kiwi dollar, like the CAD. But the timing is less than ideal right now to try and catch any falling knives. If we consider a possible 2018 rehash, things could get very, very messy for risk assets in the short term. Even though the dollar was mostly range bound this past week, we do need to keep in mind that it was mainly due to downside pressure in dollar yen, because the yen stretched natural positioning saw the yen as a favorite safe haven versus the greenback. So with a lot of that stretch positioning being unwound right now in the past few sessions, that might leave the dollar less vulnerable from a risk sentiment point of view. Now, again, using both 2014 as well as 2018 as a possible playbook, we will do well to try and find things that worked well and didn't work good in both of those examples. And two things that really stood out for me was, firstly, the dollar strengthened across the board in both 2014 as well as 2018's episodes. Things like WTI fell rapidly in both examples. And that means that maybe staying patient with things like WTI would be a good idea until the dust settles. We've anyway been waiting for OVX to calm down before we re-engage. With major pairs, though, already seeing sizable downside versus the greenback, it's not looking very attractive to try and chase the dollar higher from these levels as well. So I think right now patience is required. For the week ahead, the markets will be focused mainly on two things. The markets will be focused on, firstly, Omicron updates. So any solid data that suggests current vaccines is effective against Omicron, or news that Omicron is less deadly than Delta, could be enough to spark some reprieve for risk assets. While negative news on that front, obviously alongside a hawkish Fed, could just see further pain on the risk front. And then apart from that, Fed policy, for Fed policy, it's not so easy right now because it's clear that the recent tilt from Fed officials, especially officials like Fed Chair Powell, has been more, in my opinion at least, more politically driven. given the pressure from the Biden administration, given the pressure from that, that Senate testimony. It was the tone regarding inflation from most of those Senate members were tangible. They were really, really concerned, and I do think a lot of the change of mind about inflation has been more politically driven. But that also means that, what is it going to take for the Fed to step away from this over-aggressive tone? We either need to see inflation coming down sharply, which right now seems unlikely, at least in the short term, or we need to see a massive meltdown. Recall that it took more than a 20% correction in the S&P in 2018 to change the Fed's mind and finally see them tilt dovish again back in January 2019. So that means some more pain could be necessary before the Fed starts to change their tone. Now, looking at some possible scenarios then in the week ahead, in terms of bullish catalysts, what we will be looking for, like we said, is data suggesting that Omicron is less lethal, much less lethal than Delta. Apart from that, if we have any pushback from Fed officials on more, on a more hawkish path, that seems very unlikely right now because they literally just changed their minds over the last 2 weeks or so. So doubt whether they will come out, this upcoming week sounding more dovish. But obviously, if that happens, that'll be bullish. Furthermore, taking a look at cross-asset implied vols, we've seen a lot of upside in cross-asset implied volatility, looking at OVX, VIX, looking at the VVIX, VIX ratio, the MOVE index, looking at implied vols on the major FX side. If we can see some of these implied vols really pushing down, trending lower, that could once again be very positive for risk assets. And then taking a look at Friday's CPI on the US side, if we see a major surprise miss in both core and headline inflation coming in below the markets, well below the market's minimum expectations, that could also spark some additional risk on flows. Now, obviously, in that front, if we do see any of these catalysts taking place, we could look for some upside potential in the S&P 500. We could also look for some downside potential in things like Euro Kiwi as well as Euro CAD. Now, why Euro Kiwi? In the case of Euro Kiwi, the recent push higher has been partly positioning unwinding, partly funding trade inflows into the euro, and of course, just overall risk sentiment. But the underlying fundamentals still point to downside for this pair, and we can clearly see that, with both things like the 2s as well as 10-year differentials still pointing to a much lower spot price from where we're currently trading. I mean, that's a jaws gap, to say the least, between where Euro Kiwi spot rates are trading and where yield differentials are trading. Keep in mind that there is still a massive monetary policy divergence between the ECB and the RBNZ. The ECB is nowhere near hiking rates right now, let alone stopping quantitative easing. But the RBNZ has already hiked twice this year. And by their own projections, they see another 7 hikes between now and 2024. And obviously, the economic data has been solid. So I think once markets can find some reasons to be positive again, the fundamental outlook in terms of the policy divergence, yield differentials, and of course the very attractive carry for the Kiwi dollar versus the low yielder like the euro, it just makes sense for some solid downside if and when we finally see markets just finding some reasons to be positive again. So Euro Kiwi, a really attractive one. Very glad that we didn't pull the trigger on this from that 165. Like we said last week, we waited for the markets to calm down, to tilt a little bit more positively. We just didn't see that. We had reasons for the markets now to also be exacerbated to the downside in terms of risk assets. So patience definitely key here. But once that calms down, the fundamentals still points to solid downside here for Euro Kiwi. Apart from that, of course, is also dollar CAD downside. Now, remember that when we reached 124 back in October, we said that we didn't want to chase the dollar CAD lower because we thought a lot of the positives was already reflected in the CAD at that time. And right now, with the recent push lower we've seen in the CAD across the board, we do think that a lot of the froth has been priced out. Also keep in mind that even though we are bullish on both the CAD and the dollar, from a sequencing point of view, the BOC is still expected to pull the trigger way ahead of the Fed, and that should provide some further upside for the CAD versus the dollar. Obviously, there is a key risk, and that is oil prices. With OVX still elevated, oil is a real concern right now. So that is a less favorite right now. for me personally, but dollar CAD also a possibility, especially since we are trading right back towards that 128 psychological level, which is it's been so important going back all the way to July. So definitely want to focus on. Then in terms of bearish catalyst, just the exact opposite, right? If data suggests that Omicron is more lethal than Delta, we already know that it's more transmissible, or at least early data shows that. If we find data that says that's more lethal, I mean, that's just going to be such a horrible situation, and that's going to really flare up risk sentiment. Apart from that, if we get any stronger signals from the Fed this week on a hawkish path, so imagine we see doves coming out saying that they see rates rising next year, obviously expect more risk-off tones. Apart from that, if we see a sharp trending move higher in those cross-asset implied volatility measures, expect more risk-off sentiment to take place. And then, of course, if we see a surprise beat in core and headline CPI, numbers coming in above 7%, for example, in terms of the headline maximum expectation. If we see headline coming in above 7 for the headline, and we see core coming in, let's say closer to 5.5, maybe even 6%, expect a lot of downside, because that's going to be some scary numbers for the markets to deal with, especially with the recent tilt from the Fed. So in that scenario, again, we would expect downside for the S&P 500. It's not something that I would personally trade lower, though. And the reason why I added it in here is that if you are long it medium term, like me, obviously there can be some scope for some hedging taking place if that's the case. So keep that in mind for the S&P. Apart from that, we would also expect some downside for dollar yen and upside for euro pound. Now, why downside euro yen? We've been seeing some asymmetry for this pair for the past 2 weeks, as you guys know, where the expected move lower in US 10-year yields, obviously this blue line, have kept us from buying the dollar yen in line of that medium-term upside bias. And also with positioning being as stretched as it was for the yen, dollar yen was an attractive trade to the downside on any big risk off flow. So we do still hold to largely the same view going into the week ahead. Obviously, just keeping in mind that some of the yen's stretch positioning has started to see some mild unwinding already. So the odds for massive more, it's not as strong as it was 2 weeks ago. With that move we took to the downside. So that has diminished slightly, but the overall view remains the same. If we see any of these major bearish catalysts coming into play, expect further downside for dollar yen. The other one that can be interesting is euro pound upside. Now, even though we do still hold to a fundamental downside bias, this is going to be a pure risk trade, because the euro, obviously, as you guys know, is a funding currency. It does find or has found support recently when we've had these risk-off bouts coming into play. And obviously, when you take a look at something like sterling, it is more susceptible to risk flows. It does run a slightly higher beta. So it's a pure risk play. But the other thing also to keep in mind is that we had some surprisingly negative comments coming out from BOE Saunders on Friday. And the uncertainty about that hike in December for the Bank of England has grown. We've seen markets pricing out further expectations for that hike to take place. And if we see any further risk of sentiment, those negative comments from Saunders, that could see sterling pressured in the week ahead, at least seeing it trade more flat as opposed to down, but definitely more down and flat price action in the event of a risk off tone, and that could see some interesting upside playing out for the likes of euro pound. So that's everything from our side for this week, guys. I do hope you guys have a fantastic week ahead. Do keep in mind that all these recent developments, it's occurring during a time of the year where we are already expecting thinner liquidity and lower volumes the closer and closer we get to Christmas. And that means that any major news that we get will probably be exacerbated in the markets, especially with implied volatility still as high as it is. So that's something very important to keep in mind. But it is always worth, reminding that the current levels of stress that we see in the markets, the downside we've seen in things like the Kiwi, the downside we've seen in things like equities, etc., all of that is eventually expected to fade, right? So we do want to keep in mind that the lower and lower risk assets fall, obviously the more attractive some of those dips will become. So we do want to be mindful of where we are, but we also want to be mindful of the potential opportunities that some of these risk-off flows can be setting up for us in the medium term. So with that, guys, fantastic week ahead. And as always, any questions, don't hesitate to let us know.